JP Morgan Chase suggests that the market share of precious metals and precious metals investments in the US market, where JP Morgan Chase can track it, is estimated to be below 0.5%. What's interesting about their statistics is that they theorize that the 4-decade mean market share was 2%. So if you merely revert to mean, demand for precious metals increases fourfold in the largest savings and investment market in the world.
Rick Rule, the visionary behind Sprout Global Resource Investments, leads a company dedicated to managing alternative assets worldwide, with a keen focus on precious metals and other commodities. A fixture in industry conferences, Rick frequently shares insights on natural resource investments through various interviews. He staunchly advocates for investing in natural resources, citing a favorable confluence of economic and macro factors. Rick predicts a fourfold surge in demand for precious metals like gold and silver in 2024, once the broader investment community grasps the strategic imperative. Central to recent discourse are the central bank's sudden pivot in policy, particularly their unprecedented accumulation of metals since 2021. Historically tethered to U.S. Treasuries, these banks' abrupt shift has captured the attention of seasoned investors and analysts. Rick and his peers swiftly discern the correlation between America's tumultuous economic landscape and the central bank's newfound interest in precious metals. He foresees a cascade effect, with not just central banks, but also money managers, pension funds, and family offices, bolstering their gold and silver holdings amid prevailing economic uncertainties. Rick's prognosis? A looming quadrupling of demand for precious metals, inevitably leading to substantial price surges. Offering a glimpse into his recent interview with Mike Maloney, Rick delves into central bank strategies, extols silver as a lifetime opportunity, and candidly shares his apprehensions regarding gold and silver prices in 2024. Don't miss out, subscribe, and hit the notification bell for more insightful content. Explore our library of videos covering gold, silver, and other precious metals. Thank you for tuning in. Enjoy the show.
The first is that the increase that you've seen in the gold price hasn't come from retail buying. In fact, if you look statistically at the precious metals ETFs, what you've seen is retail selling in Europe and the United States. The buying has taken place by central banks. And I think that's the key reason why the gold stocks haven't moved. Central banks don't buy gold stocks, they buy gold. If you begin to overlay retail buying on the central bank buying that you've seen over the last 2 years, then I think you see an explosive move in the gold price. And I think at that point in time, it probably carries through to the stocks too. The second comment that I have for you is that the generalist investor still can't spell gold. They don't care. They think that in an inflationary period, that they do better with technology companies that have high operating margins, that the best guard against inflation is a hugely profitable business. There's some truth to that. Buffett did extraordinarily well through the decade of the 70s by focusing on companies that had pricing power. And I don't discourage people from looking at that, but I also do think that people need to pay much more attention to inflation protection that is easy to understand. The difference between gold and say NVIDIA is that it's pretty easy to pronounce and understand gold. And NVIDIA, I just hope I got right. The third comment I would have, however, is that interest in gold among young people and non-traditional people is increasing very rapidly. At my own site, Rule Investment Media, I'm getting an average of 40 new subscribers a day. And they aren't the old, bald, fat, white, God, guns, and gold crowd. The new audience is at least 35% female and more than 50% non-North American. So I think it's important that the gold industry and the gold mining industry begin to address new audiences. I think that's very important. What you'll find is that interest among people under the age of 40 in gold and silver is explosively high, measured by my own database. And JP Morgan Chase suggests that the market share of precious metals and precious metals investments in the US market, where JP Morgan Chase can track it, is estimated to be below 1/2%, which is to say,
Wow.
suggest that less than 1/2% of all savings and investment assets in the United States are comprised of precious metals and precious metals related investments. What's interesting about their statistics is that they theorize that the 4-decade mean market share was 2%. So if you merely revert to mean, demand for precious metals increases fourfold in the largest savings and investment market in the world. To put that in context, the US market controls between 22 and 23% of savings and investment assets on the globe, including foreign investments in the United States. If you had reversion to mean, you would see a quadrupling in demand in a market that comprises between 22 and 23% of the total market for savings and investment assets on the planet. That's precisely what I think is going to happen, which is one of the reasons why I'm so bullish about gold and silver.
Rick holds a steadfastly bullish outlook on precious metals, regarding both gold and silver as true currencies and the inevitable solution to the impending collapse of the global financial system. While some enthusiasts rejoice over recent upswings in metal prices, with gold climbing from $1,821 per ounce last October to over $2,300 presently, Rick remains measured in his enthusiasm. He anticipates far more substantial gains on the horizon, likening the current state to a prelude before the real crescendo. For Rick, the true symphony begins when gold reaches heights of $7,000 or $8,000 per ounce. Rick's stance stems from a growing disillusionment among investors with the U.S. Treasury market, exacerbated by the government's unrestrained money printing. As of early Thursday, the U.S. national debt soared to a staggering $34.68826 trillion, with a budget deficit nearing $2 trillion. While official figures peg the deficit at $1.812 trillion, the actual shortfall is a daunting $11.957 trillion, as per the U.S. debt clock. Moreover, the net interest on the national debt is fast approaching $1 trillion, numbers that would have seemed unfathomable just a few years ago. Returning to Rick's conversation with Maloney, these concerns underscore the urgency for investors to consider precious metals as a sanctuary in an increasingly uncertain financial landscape.
What I would like to do in terms of my discussion about the gold market is keep expectations rational, keep expectations real. Remember that prices are set on the margin. They aren't set through the whole value chain of 4 times change in demand, given that not all of the gold that's held is held available for sale, could have dramatic increases in price. JP Morgan Chase also estimates, and they say it's an estimate because they didn't have accurate records then, that in 1980 and 1981, that they believe the market share for precious metals and precious metals related assets in the US market was above 5 and, quote, perhaps substantially above 5%. So if rather than merely returning to mean in the US market, if demand for precious metals, or rather, if precious metals market share took out the old nominal highs, then you have a truly goofy number. The truth is, however, that too many gold positive channels try to appeal to people's emotions. They try to give them really wild clickbait headlines. And I don't want to do that. I want my audience to be prepared for simple arithmetic. And the simple arithmetic is dramatic enough. In my experience, the immediate impact of a variety of fears can impact the precious metals price. Looking at history, The most important variable is the one that you track, which is to say the fear that savers and investors have about the maintenance of their purchasing power in fiat currencies. In the very near term, I think what happens, I think I've observed this over 50 years being involved with investors, is that as investors begin to feel the fear associated with the deterioration of their purchasing power, they use any psychological excuse to express that fear. And so war, or the threat of war, becomes the excuse to exercise a strategy that they were already considering as a consequence of financial fears. Now, the second part of your statement is very profound. The want of societies around the world to exercise their political will, given the unwillingness of their own citizens to pay for it, means that they have to borrow or they have to print to wage these wars. Printing new specious currency units without doing anything to increase the underlying value of the economy always undermines the value of the existing currency units. If you have, let's say, 1 trillion currency units, call it what you want. Let's call them Mikes, just for fun. And Mike decides that he's going to print 200 billion more Mikes to keep the trillion already in existence company without doing anything to increase Mike's net worth or his income or the utility he generates. What he's done is basically devalued the existing stock by the amount that he's added. And there's no particular difference between a Mike and a dollar. They're both specious currency units. The difference, I guess, is that the dollar has an army and a navy behind it, and Mike is somewhat more peaceful. But that's the only difference.
Rick has delivered a series of poignant remarks, all underscoring the precarious state of both the U.S. and global economies. Amidst the confusion, investments in precious metals and commodities offer a sanctuary for investors seeking refuge from the system, allowing them to allocate funds into tangible assets immune to artificial inflation. However, navigating the precious metals market necessitates a steadfast commitment to a long-term perspective and adherence to one's investment strategy, despite market fluctuations. In these uncertain times, the economy exhibits unexpected resilience, yet the specter of escalating government debt looms large, promising further turbulence and uncertainty ahead. This is why seasoned investors like Rick Rule advocate for a return to trusted hard assets like gold and silver, which have stood the test of time and remained faithful to their intrinsic value for centuries. What are your thoughts on Rick Rule's insights and analysis of the current economic landscape and market conditions? Feel free to share your comments and observations below. Additionally, don't forget to like this video, subscribe to the channel, and enable post notifications for more insightful content. Thank you for watching.